guys, and welcome back to my channel. Today is a little bit different. I have my dad involved in this one with me. He used to be a mortgage broker, he's retired now, but we're coming on and giving you some advice for a first-time buyer because my demographic is between 18 and 24, general age of first-time buyers within that category. So yeah, I thought this would be useful. I'll stop rambling and get straight on into it, but if you do enjoy, please like, subscribe down below. If you have any more questions about what we've not covered, leave it in the comments below and we will get back to you. But yeah, enjoy. As I've just mentioned, this is my dad. Yeah, do you want to introduce yourself a little bit?
Hi, I'm Roy, Lara's dad. I retired as a mortgage broker. My background was in mortgages for many years, worked at Royal Liver, and then 2006 I decided I'd work for myself, which I did for about 9 years, and decided I'd take early retirement. But try to keep up to date with what's happening in the mortgage market, so hopefully I can give you, particularly first time buyers, a few pointers. Obviously it's not advice because everyone's circumstance is different, but yeah, I hope you find it useful.
So the first question I'm kind of going to ask is, I'm looking to buy a house.
Yeah.
Where do I start?
Right, okay. I always used to think it's wiser to buy a house that needs work doing to it, or the cheapest house you can find in a good area, rather than the best house you can find in a rundown area or a tired area. I know you're going to get onto things like how much to pay for it and deposits and things, but great to be thinking about buying a house, getting a mortgage yourself that you start paying off rather than paying somebody else's mortgage by renting for many, many years. So,
okay.
Yeah.
So would you recommend, if you can, go and buying a house at 21 rather than renting for 5 years before you buy a house? If you can. If you can,
yeah. There's lots of pros and cons, but overall, buying a house it's the biggest purchase you'll ever make, apart from your next house and the one after that, and it's different to any other purchase you make. So maybe if you buy a car, the second you drive it off the driveway, it's lost some value. It's just the way it is. So if you've borrowed money to buy a car, immediately the car's worth less, but the debt is still the same. Okay. If you're buying a house, the hope is, and generally this is what happens, over time the value of the house will increase and your mortgage, or the loan, a mortgage, that's all it is, it's a loan, money you borrow to buy a house, the loan reduces. So as the property value increases, your loan reduces, so you've got an asset that's appreciating.
So I found a house that I like and I'm going to view it. What are some things I should be asking when I'm viewing a house?
I suppose what you've got to bear in mind, the people selling the house are very keen to talk about its good points and might not reveal some of the things that might inhibit you from buying it. So the kind of things you'd be interested in is how long they've lived there, and if it's only a very short time, well, does that set alarm bells ringing? Why would you move so quickly? Some idea of what their bills are for things like gas, electric, council tax. Have they had any problems with neighbours? What's it like at night? Is it quiet, or yeah, that kind of thing?
Okay.
Yeah.
Would you be asking the estate agent any questions, because they're kind of more for the people that are living there?
They are.
What kind of things should you be asking the estate agent?
Ooh, that's a really good question. Probably similar things, but again, bear in mind it's in the estate agent's interest to get a buyer. So they're obliged, they've got to tell you the council tax, how much that is. They probably won't know how much the owner pays for gas and electric.
Yeah.
council tax, how quickly do properties sell in this road? Are they aware of any developments going on in the area? You know, maybe there's a planning application gone in for the land at the back, or you know, next door is just about to sell it to a developer and there's going to be 16 flats put up next door.
Yeah.
So stuff like that.
Does square footage matter?
No, not particularly. Obviously, it's nice to have what we call a bigger footprint. So the more square foot you've got, the bigger the house, and that stands to reason. But no, it's not that important really.
Oh, some other kind of things that I don't think you have mentioned, like, are the buyers part of a chain? What difference does a chain make?
Okay, a chain is where if the people you found a property and you've decided you want to buy it, okay, so the next thing you need to do is decide how much you're prepared to pay for it, and we'll cover that a little bit later on. Now, the people you're buying from are likely, not guaranteed, but likely to be buying a house to move into. Maybe they're going to live abroad, so it wouldn't be the case. But if they're buying their next house, that's one link in what we call a chain. So you're buying theirs and they're buying their next house. Now, again, it's quite possible that who they're buying from is also buying again. So you get into this situation where you're all relying on each other to find a property, agree a price, and then agree a time scale when you can all move. So it can get a bit more complicated the more transactions there are in the chain.
Okay. If you're looking at a house, we kind of get onto this a little bit later, but if you're looking at a house and you've kind of decided that you want it, is it worth getting a surveyor in?
No, not at that point.
Okay.
A surveyor will cost you, I don't know, 300, 350, just as a very rough guide, depends on the house and all sorts. So I wouldn't go to that expense initially.
Okay.
So the first point of call really is to negotiate with who you're buying from. Now, maybe they put the house on the market for, let's say, 140,000, just a random figure. What is normal practice, particularly for first-time buyers, is to make an offer, a tentative offer. So you might say, well, yeah, we like the house, but our budget doesn't quite stretch to that. If we offered 132, would that work for you? You would put the offer through the estate agent. So don't give the offer immediately to the property owner. Go back to the estate agent, explain, yes, you like the property, but maybe it's a little bit overpriced. Can you put an offer to the seller of 132 or maybe 135? Estate agent contacts the seller and comes back to you whether it's accepted, or maybe they'll say, no, we can't accept 132, but if you can get to 136, then you've got a deal. Okay. Now, at that point, there's nothing binding. You're not committed to anything. All you've said is, this is the price that, as long as everything falls into place, that's how much we will pay you. And again, the steps along the way which we'll come to.
Okay. So kind of backtracking a little bit.
Yeah.
Kind of. Not really. But deposits.
Okay.
How do you know how much you can afford is my first question.
Right. What I always suggested to my clients was just to go into Google and put mortgage calculator, and a whole range of them come up. And you can then play around with figures. So coming back to that £140,000 property, let's stay with that for now. So for 140,000, it's best if you can put down at least a 10% deposit, so 14,000, if you can. So put these figures into the mortgage calculator, purchase price 140,000, deposit 14,000. So what would a mortgage of 126, which obviously is the difference, cost each month at an interest rate of, say, 3%? And there'll be two options. One is what we call a repayment mortgage. So that's where you pay interest each month, and also in the early years a tiny amount also goes to start reducing that debt. Okay, so as a ballpark figure, a mortgage of 126,000, 3% might cost you, and again this is ballpark figures, might cost you £650 a month. Okay, over 25 years. And 25 years is the fairly standard length of time that you would go for as a first time buyer. Now the other type of mortgage is what we call interest only, and as the name suggests, you only pay interest on the debt. So in 25 years time the debt is still 126,000 because you haven't paid any of it off. Monthly payment is a lot lower than it would be if you have a repayment mortgage. But, and this is the big but, most lenders will want to know how you're going to repay that 130,000, and most of them will want you to put some savings plan into place to build up that 130,000.
To pay it off in cash. To
pay it off in cash
okay.
in 25 years. And that can be through investments and of course there's no guarantees with investments.
Yeah.
Most people, and I would suggest it's the safe and best way to go, is to go for a repayment mortgage. And you know that debt is going to clear itself over 25 years.
Okay, so it completely wipes after 25 years and then the house is yours?
As long as you keep the payments up.
Okay. If, say I am looking to buy a house in 5 years' time, I don't know where, I don't know who I'm going to be living with, I don't know if it's going to be on my own or with a partner, how much, I don't know if you're going to give me a figure or what, how much should I be aiming to save for if I was to look for a house in 5 years' time?
Good question. So just coming back to the scenario we've just covered, where you've got a repayment mortgage of £650 a month, a really good practice would be to say, well, okay, if I'm prepared to take on a mortgage of that amount, I need to prove to myself over the next few years while I'm saving up that actually I can afford £650 a month. So why don't I commit to putting £650 a month every month without fail into a savings account? And I know then that if house prices are the same, if mortgage rates are the same, there's always loads of caveats. If nothing has changed, I know, because I've done it for 4 or 5 years, I know I can afford a mortgage of £650 a month. Oh, by the way, I've now saved £7,000 a year, so I've now got a good deposit.
Okay. Would you say to do that if you're paying rent somewhere else?
That is really difficult.
So if I'm paying £600 rent a month, which a lot of people might be, at the moment I'm probably paying £350, but that's a student house, not council tax, not bills, nothing. Would you still want me to put the same amount that I'd be putting away in a mortgage, or just the difference? Just the difference.
I think it'd be
pushing
unrealistic to expect you to find £650 plus your £350, £1,000 a month. That is a big ask. £350, continue paying your rent, and as much as you can, certainly at least another £300 into savings. And then you're getting into the discipline of paying the mortgage amount that you expect to pay.
Still on the topic of deposits, if I have 20% of my mortgage saved up, is it worth putting the 20% down? So if going back to the 140,000 example, if I have 28,000 in my bank account, is it worth putting that as a deposit, or is it worth putting less as a deposit so that I have the extra money to work on the house?
Yeah. If you put down a bigger deposit, then obviously you're going to be paying less each month on your mortgage, and you might get a slightly better rate of interest charged by the bank, because there's less risk then for the bank. So you've only borrowed 80% of the property value. So even if the property value did reduce, there's still some leeway there for the bank. Having said that, I personally would probably put 15% down and keep 5% back, because when you move into a house, there's always going to be work that needs to be done. And there's always unforeseen circumstances. So I don't know, your income might drop for some reason. Perhaps you can't work for 3 months or whatever. At least you've got some reserve there to make sure that your payments, monthly mortgage payments, continue. So I'd hold some back for those 2 reasons.
I think that's all we've got on deposits. I'm not 100% sure. We might come back to something. But moving on more to mortgages, you found a house, you want it. Mortgage ideas, mortgage thoughts. Do I need a mortgage broker, or can I do it myself?
You can do it yourself. There's nothing to stop you doing that. But mortgages are quite intricate. So the interest rate you see isn't the only consideration. So some banks will offer you a slightly lower interest rate, but might charge you £1,000 fee in order to get that better rate. So you then got to calculate whether it's worthwhile paying the £1,000 to save 50 quid a month. So at what point does it become more beneficial? Stuff like that. When you choose a mortgage, again, there's various different types. As a first-time buyer, you might want to think about taking a mortgage where the rate is fixed for the first few years. Now, at the moment, interest rates are as low as they've ever been, I think. The only way they can move is upwards. Nobody's really expecting that to happen over the next 2, 3, 4 years, who knows. But some event can come out of the blue. The pandemic we're just coming to the end of. 2 years ago, if you'd have said we're going to be locked down, and it was unthinkable. So unthinkable things can happen. So interest rates could potentially, there's no reason to expect it, but could increase quite rapidly. So if you went for a fixed rate mortgage, you know that the rate that you're being charged by the bank can't change for the duration of that fixed rate period. So you can have a fixed rate for 2 years, for 3 years, for 5 years. And generally, the longer the fixed rate, it's slightly higher because it's giving you additional protection. So you might get a 3-year fixed rate at, again, just random figures, at 3%, or a 5-year fixed rate at 3.25%. Right? So you might think, well, why wouldn't I take a 5-year fixed rate? Because I've then got peace of mind. I know I can afford the monthly payments. I know they're not going to change. Happy days. The downside to a fixed rate is that if you decide to repay part of your mortgage, let's say you inherit 20,000 and you think, oh God, I'll reduce my mortgage. There'll be a small penalty for paying off some of your mortgage within that 5 years.
But you could just save it, put it into investments, let it grow, and then pay off later.
Absolutely. And again, if you decide in, let's say, 4 years' time, you want to buy a bigger house, and the whole process starts again, then you need to make sure that the mortgage you've taken on is what we call portable, which means you can take the mortgage with you, secured against the new house. So therefore you don't have to repay it. And therefore you don't have to incur any penalties. So you just carry it with you. And that comes back to the point about, do I need a mortgage broker? A good mortgage broker will go through all the intricate details of each mortgage
Yeah.
and tell you the pros and cons of it.
Mhm.
Okay, you can do it yourself. It's wise, particularly for a first mortgage, to get some expert advice.
Yeah.
Now you probably have to pay, I don't know, 300 quid for a broker fee, but in the long run, in the scheme of things, £300 isn't that much.
Mhm.
So for safety's sake, I'd probably recommend going through a broker.
Okay. So you have touched on this, but in a short summary, what does a mortgage broker actually do?
Okay, so a mortgage broker will find out as much about you as they can. So, first time buyer, what's your employment status? What's your credit record like?
Mhm.
So have you proved that you've had a credit card and you've kept your payments each month without fail, that you manage your bank account, that you pay your mobile phone bills on time, all that kind of stuff. And to do that, you'll need to provide statements. With your permission, he will do a credit check, an online credit check, and that will give him an indication whether you're likely to be accepted by a bank. Once he knows that, and he's talked through with you how much you're looking to pay for a property and how much deposit you have,
Yeah.
he'll tell you whether it's realistic to get a mortgage of the amount you're looking for.
Okay.
And if so, how much you'd have to pay each month for it. Okay, so that's the start of the process. Once you've had an offer accepted on the property through the estate agent, the mortgage broker will identify the best mortgage for you, whether it's fixed rate or variable rate, so rates go up and down. Because he's done a credit check and affordability, he will then say, yeah, I believe this lender would be able to lend you the amount that you're looking to borrow. Shall we try and get an approval in principle from that lender?
Mhm. Okay, I'm having a mortgage broker. What paperwork do I need?
Okay, so the mortgage broker at this point is probably acting on behalf of the lender. His mindset is, okay, if I was a lender, what confidence can you give me that if I lend you 124,000, I'm going to get it back and you're not just going to leave the country?
Yeah.
So it'll be things like, okay, prove to me what your income is, and for that I'll need pay slips, ideally a P60, which is your end of year, full tax year amount, and your employer will give you that. He will need to know where your deposit is coming from. So if you've got a savings account, you'll need a copy of your statement for that. Now, a lot of first-time buyers have a gifted deposit from their parents. So in that case, your parent, whoever's giving you the deposit, will need to write a letter addressed to you confirming this is a gift without reserve. You don't expect, I don't expect it back. So basically it's your money. So it's that kind of thing. The lender will also need a copy of bank statement that shows your monthly salary going in and any monthly commitments you've got going out. So your mobile phone bill, gas and electric, council tax if you're already paying that, your rent certainly. If you are renting, ideally you'd like a statement from the landlord confirming that you paid on time, never missed a payment, that kind of stuff.
How, because you mentioned like a P60 from an employer, how does that kind of work if you're self-employed? Because I think a lot of people now are starting their own businesses, especially after lockdown.
Yeah.
How do you prove you've got money?
Okay, well, if you're self-employed, at the end of each tax year, you're obliged to send in your accounts to Inland Revenue, showing your profit and loss.
Yeah.
Now, a lender will generally look for 3 years' accounts, and they'll want to see an increasing profit for each year. So, if you've made 10,000 year one, 12,000 year 2, 15,000 year 3, they're happy.
Okay.
But if it's 10,000, 15,000 and then 12,000, that will raise concerns. Why has it dropped down?
Yeah.
What confidence have we got that
It's
business
not.
is growing?
Yeah.
Yeah.
Okay. So you mentioned before having a good credit score and how it's really important.
Yeah.
Why is that so important? You've kind of touched on that. And how can you build your credit score? So how could I build my credit score now without a credit card for me buying a house in the future? Or with a credit card, but I don't have one, so.
Yeah, okay. It's actually quite important to take on some credit commitments. So, yeah, a lender will need to know that if they're giving you money for a house, that they're going to get it back. On a very sort of basic level, just imagine a good friend came to you and says, look, I've got something I need to buy. Will you lend me £1,000? Assuming you had £1,000. Will you lend me £1,000? What kind of questions would you be thinking about? Well, how long have I known them? What's the likelihood of me getting that back?
Yeah.
Do I trust them? Have they got a job so I know they've got an income to pay me back?
Mm-hmm.
Continue that up to the next level. With the bank has the same mindset.
Yeah.
With a credit score, they want to know that you've kept your promises on any commitments you've taken. And taking a credit card is a good idea because that's an easy way to demonstrate that, yeah, you put stuff on your credit card and each month you clear the debt. So you're managing your finances well. Mm-hmm. And that's a big tick in the box when it comes to applying for a mortgage.
So I don't have a credit card. Is it still worth me paying my own phone bill, rent, council tax?
Yeah.
Is that still viewed as a good credit score?
Absolutely.
Even if I don't have a credit card?
Yeah, yeah.
Okay.
Yeah.
It was going around the internet. It's kind of just restarted. It closed a few years ago and then it restarted last December. The Help to Buy ISA. What is it? Is it worth it?
Okay.
How does it help?
Yeah. The Help to Buy ISA is, instead of putting money just into a savings account at the bank, you open a Help to Buy ISA and you put, I don't know, £200 a month or whatever you can afford into this, up to a maximum of £4,000 a year.
Mm.
And the government will add 25% to it, tax-free.
Yeah.
So if you're able to put away £4,000 at the end of year one, the government have added another 1,000.
Mm-hmm.
So your 4,000 savings is now worth 5,000.
Yeah.
The downside to it is you can only use that money to buy a house.
Mm-hmm.
Okay.
Yeah.
If you, in 5 years' time, you think, do you know what, I've gone off the idea of buying a house, I'm going to live abroad.
Mm-hmm.
If you can withdraw the money, but
Yeah.
you wouldn't get the money that the government have added in.
Mm-hmm.
So you just get your 4,000 per year back.
So you don't lose any money?
You don't lose money by it.
You just don't get the gained money?
Absolutely.
Okay. What's a lifetime ISA then? What's the difference? Is a lifetime ISA also a pension thing?
Yeah, if you're, a lifetime ISA has the same in principle, but if you're aiming to build up a lump sum for retirement, it's more beneficial to put it into a pension rather than a lifetime ISA.
Okay. What are the different kinds of mortgages? What are the different types?
Okay, so you split your mortgage into the amount you borrow, which we call the principal. So that 124,000 is principal, and while you've got the money from the bank, you'll have to pay interest on it. Again, as we touched, a capital repayment, a repayment mortgage is where you pay the interest that's due and a bit more to start reducing the mortgage debt over whatever term you go for.
Yeah.
So that's called a repayment mortgage. That's the safe option. That's the one that probably, 85-90% of people would go for.
Mm-hmm.
The other is the interest only, so the 124,000 remains outstanding and you only pay interest on it each month. So in 25 years, the bank is going to come and knock on your door and say, do you remember we lent you 124,000, can we have it back please? So you need to have made a plan to build up that 124,000.
Okay.
So that's the principle.
Yeah.
Now in terms of different types of mortgages that banks offer, you can go for a fixed rate mortgage, again we touched on earlier, where you guarantee that the interest rate can't change for 2 years, 3 years or 5 years. Some banks will actually give you a 10-year fixed rate, which sounds great, but again there's always cons to it, pros and cons. 5-year fixed rate for a lot of first time buyers would be the ideal.
Yep.
Or the alternative to that is a variable rate, and as the name suggests, the initial interest rate is probably slightly lower than a fixed rate, but as and when the Bank of England increase rates, then your monthly payments go up as well.
Yeah.
And because interest rates are so low at the moment, the likelihood is at some point your mortgage payments would increase if you went for that option.
Okay. Is it worth getting a shorter mortgage if you can, or is it worth just sticking with like a 25-year if you could pay it off in 15?
If you're able to get a mortgage that you can afford, and that's the key, so monthly payments are going to be much higher the shorter the mortgage term, but overall the amount you pay will be drastically reduced. The amount you pay over 15 years will be vastly lower than the amount you would pay over 25 years. But each month your payments would probably be 50% higher. So instead of that $650 a month we were talking about, it could be £1,000 a month.
Yeah.
As long as you know, not simply confident, but as long as you know that you'll be able to afford £1,000 a month, then yeah, that might be a good idea.
Yeah.
The alternative is to take a 25-year mortgage, so you're only committed to pay that $650 a month, but then you can opt to make monthly overpayments. So the additional £350 is optional.
Yeah.
And as long as you pay it, the debt is reducing much quicker anyway.
Okay.
So that would make more sense.
Does it bring the end of your mortgage closer if you're making those overpayments?
Yeah.
Okay.
Yeah.
So in theory you could opt for a 25-year mortgage but pay it off in 15?
Yeah.
Okay, I didn't know that.
Yeah.
If I'm buying, hypothetical, I'm buying a house with my boyfriend, is it better for us to be joint tenants or tenants in common?
Good question. Okay.
What's the difference?
Yeah. Okay. When you're joint tenants, if you're in a stable long-term relationship, or married, or just steady long-term relationship, if you are joint tenants, you both own all of the property. So if your boyfriend were to die, heaven forbid, all of the property is yours. Okay. And vice versa.
Yeah.
Now with tenants in common, you can opt to, instead of, you can opt for any proportion of the property. So let's say you had coming back to that £140,000 house again, let's say you had a deposit or savings of 40,000, which you're happy to use as a deposit. Now,
a big deposit.
Yeah, big deposit. You might then think, well, hang on, because my boyfriend hasn't put any money in, it's not really fair that we own this 50-50.
Yeah.
So between you could agree and have a legal document that says, actually, you own 65% of the property and your boyfriend owns 35% of the property.
Yeah.
Or any other proportion that you like. So yeah, you can do that. Now if your boyfriend were to die,
Mhm.
his proportion of the property can be left in his will to whoever he likes.
Okay.
So you don't own the whole property then.
Yeah.
You own your 65%
Mhm.
or whatever.
And have someone else living next door.
Well, probably what would happen at that point is you would then sell the property,
Mhm.
you retain your 65%, and the 35% goes to whoever has been left it in the will.
Okay.
Yeah. So there's a lot, isn't there?
Yeah.
And,
But that's why we're making this.
yeah. And this really is why you need to sit down with a qualified, honest mortgage broker.
Mhm.
Yeah, somebody ideally who's been recommended and you
Yeah.
can trust. Because of my connections, I've got a couple of them. But
I'm sorted, guys. This was actually asked when I put on my Instagram, like, does anyone have any questions? This was one of them. How does the change of stamp duty affect a young person's chance of buying a first-time home? I don't know what that means.
okay, stamp duty is it's a tax on buying a house.
Mhm.
However, the recent changes are that anybody buying a house up to £500,000,
Mhm.
there's no stamp duty on it
Okay.
at the moment.
Yeah.
In September, that comes back down to 250,000. Check on that. Do your research. I'm not 100% on this, but then after that, at some point, it comes down to what it's been for a good while now, which is 125,000.
Okay.
So, if you bought a house for, let's use that 140,000. I don't know where it came from, but it's useful.
Yeah.
So, if you bought a house for £140,000, you would pay this tax, this stamp duty, on the difference between the purchase price, 140, and the tax-free threshold of 125.
Mhm.
Okay, so you'd be charged 1%
Yeah.
of £15,000.
Yeah. So an extra £150.
Uh,
Yeah.
Yeah. So it's not
Yeah.
it's not huge. Obviously, the higher the value of the house, the bigger the stamp duty.
Mhm.
But what anecdotal evidence says that when the stamp duty holiday came in, that buyers simply increased the asking price for their property. They thought, oh, if somebody doesn't have to pay £1,000 in stamp duty, we'll just add it onto our price.
Okay.
So it's been kind of counterproductive.
Instead of people being able to afford more, people are just kind of doing it backwards and being like, we can get more for this.
Yeah,
Okay.
yeah. So, and again, that leads on to another thought. It's going off train a little bit. Because interest rates have been so low for a while, and things like this stamp duty holiday have been brought in,
Mhm.
property prices generally, not everywhere, but generally, have increased kind of 6-7% a year for the last few years.
Mhm.
So for first-time buyers, it's become really difficult to be able to afford to buy a property. Now, my feeling is, and this is purely feeling, there's no scientific method to this, but if I was advising you as my daughter,
Yeah.
I would say don't rush into buying a property in the next couple of years,
Mhm.
because I can see we'll get to the point where interest rates have got to rise.
Yeah.
And coming out of the pandemic, when the furlough scheme ends, I think there's going to be more and more people made redundant. If people are out of work, they won't be able to buy a property, particularly if interest rates and therefore mortgage payments are going to be higher.
Mhm.
So I can see property prices reducing.
Okay.
It's against the norm, but I think they've gone too high too quickly, and I can see them coming off a cliff, maybe dropping 10-15%.
Mhm.
So I would say don't rush into buying a property in the next 12 months. I think there's going to be better prices to be had, perhaps 2023, something like that.
Just note, this isn't actual advice.
It's
this
not
is
advice at all.
guidance.
Yeah.
Just making that clear.
Yeah,
This is
so
not a
it's
don't
not
buy
advice.
a house. And then another one, what is LTV?
LTV is loan to value.
Okay.
So it's the percentage loan you need to buy the property. So using that 140,000.
Back on it again.
Yeah. If you've got a 10% deposit, the loan to value, you need a loan of 90%.
Yeah.
So the LTV on that property is 90%.
Okay. Whereas if I had a £40,000 deposit on that amount,
Yeah.
it'd be like a 70% loan to value?
There or thereabouts.
I've forgotten maths.
And the LTV, the lenders will offer you a better deal the lower the percentage you're borrowing. The lower the LTV, the better mortgage options you've got.
So in that sense, it's better to pay.
Bigger deposit.
Yeah, put down a bigger deposit.
Yeah, but don't put all of your money in. Keep some back for those tweaking of the new property, or just have some money in the bank,
net.
just in case something happens.
Okay.
Yeah.
Well, that's the end of the mortgage section.
Okay.
I'm going to say we have one more section, but there may be more if I've forgotten anything. Closing a deal. What is a mortgage in principle? You have mentioned this, but I don't know what it is.
Okay. So when you go to a mortgage broker and you've provided all that paperwork, he will, having identified the most suitable mortgage for you, in conjunction with you and discussed what your needs are and wants and preferences and stuff like that, he will then identify the best mortgage to go for from his, well, when I was a broker about 4 or 5 years ago, there was over 4,000 mortgages available, and obviously we use a piece of software that filters stuff out. So let's say the best mortgage for your circumstances is with the Halifax. Okay, so the broker then goes onto the Halifax website through his password protected whatever, puts all your details in, presses the button, and within 20 seconds Halifax will have checked all their criteria, will have done your credit check, and come back with a one of 3 decisions: accepted, rejected, or referred.
Okay.
Now referred means in theory it's okay, but we need more information.
Yeah.
Okay. If you get the accepted back, you then know that you're going to be accepted by Halifax for that mortgage once you've agreed the price with the through the estate agent.
Okay. What's a solicitor? What do they do, and do I need one?
Yeah, you've got to have a solicitor.
Okay.
Using Halifax, again, it's just easier to, instead of popping around. The Halifax have their own in-house legal team, and you've got to have your own independent mortgage, or independent from theirs. Solicitor, yeah. So you can choose any solicitor that you want. You probably find that the mortgage broker that you use will be able to recommend a solicitor to you, but you're not obliged to use that. You can go online and search. So a solicitor will make sure that the people you're buying from actually own the property.
Okay. How hasn't that been checked at this point?
Well, there's no reason to. They'll make sure the property is registered, that there's no outstanding charges against the property. So the previous owner isn't owed 100,000, or there isn't a coal mine in the back garden, or stuff like that. So you've got to have a solicitor. Okay. It will cost you in the region of, again, it's a ballpark figure, 400 thereabouts. So the solicitors, once you've been accepted in principle for a mortgage, you'll complete a full mortgage application, either a paper one or sitting alongside the broker and do it online. When Halifax receive your application and any fees that you've got to pay them as part of the mortgage, they will then instruct a valuer. Again, it's from their end, because they need to know that your brother isn't a valuer on his on the back end. There's different types of valuation. Standard basic valuation is usually enough, particularly for a modern house, or you might want to pay extra for a proper survey report. So valuation, ballpark figure 300, full survey 600. If you're buying an older house or in an area that's maybe had subsidence, or it might be worth paying for a full mortgage, full building survey.
Okay.
Yeah.
I've got 2 more questions for you. We're almost done. How long does it take between putting in an offer and moving in, generally? What is a general time frame?
Again, it comes back to if there's a chain.
Yeah. If you can do it with a chain and without a chain.
Okay. So if you're a first time buyer and the people you're buying from are going to move abroad, so there's nobody else involved.
Yeah.
By the time you've put your mortgage application in and got the mortgage through, I would say allow yourself between 2 and 3 months, as long as everything comes together quickly. Yeah. What will generally hold it up is the legal work, the solicitors.
Yeah.
Because they've got to be really thorough.
Yeah.
They can't make a mistake.
Yeah.
So probably nearer 3 months. Now if it's a chain, you might have 6 or 7 transactions involved.
Yeah.
And you can virtually guarantee one of them there's going to be a blip. Something's going to go wrong, someone's going to be made redundant, a solicitor's not going to be able to find the title deeds, or whatever, anything can go wrong. So it's how long is a piece of string, really.
Yeah.
Anywhere from the basic 3 months up to, I had a case that took just under a year to go through.
Yeah.
And of course when you get to that point, people in the chain say, we can't wait any longer, you know, forget it, we're out of the chain. So the whole chain breaks down and you've got to start again. So it's an impossible one to answer, unfortunately.
And then this is not kind of going on under any umbrella terms, I guess. What are the extra costs of buying a house that you don't think about when you're putting a mortgage in? Like you've mentioned, the solicitors, the surveyors, the mortgage broker, the banks, I don't know. You've moved house more than I have.
Yeah.
How much extra do you need? Minimum.
Try and keep a couple of thousand back. No, that will depend on which mortgage you go for. There's a lot of mortgages out there where there's no additional fees.
Okay.
Yeah, loads of them.
Yeah.
Particularly if you go for a variable rate mortgage, you probably won't have any fees to pay for the mortgage itself. A broker will charge you $300-400 maybe for the advice and the processing the payment, the transaction, and hand holding and being on the end of the phone when things go wrong, and we'll chase the solicitors for you, and he'll keep a good one. We'll make sure everything's moving forward all the time. So £300 or £400 for that. Yeah. Survey fee, again, $300-350 depending on the property price. Yeah. Solicitor, maybe 400, that kind of figure. So we're up to, what was that, 4,700, just over 1,000. Yeah. And don't forget removal costs. So when you get to own the property, how are you going to move all your furniture in and stuff like that? You'll need insurance for your property.
Okay. Before you move in?
From the day you move in.
Okay.
Yeah, so, again, just Google home insurance, buildings insurance.
I'm sure that'll be mentioned to you by like a person.
Your broker will mention it. So yeah, I hope that's all been helpful. It's not advice, as we've said a few times. I've got to be very careful about that. And I've probably mentioned a few things there that it's my feeling about maybe property prices are going to come down. About who knows? Yeah. It's a gamble. But as I say, I hope it's been useful. If you've got questions following this, let Lara know, and then I can try and respond to them. If you're searching around for a mortgage broker, as I say, I've got a couple of contacts I'll be happy to give you names to, and it's up to you how you follow that up. But yeah,
Fab.
Okay.
Thanks a lot. Well, I hope that was of some use to you. If it was, as my dad said, just leave me a comment below if you've got any more questions. I'll get him to answer them. I've got no idea. But yeah, and if you are looking for a mortgage broker, again, leave it down below and Dad can probably recommend you someone. But yeah, if this was useful, please give it a thumbs up, subscribe down this side, I'm pretty sure. And yeah, thank you so much for watching. I know it was a long one, but I really appreciate you. So yeah, thank you very much. See you soon.